Well, one of the stock stories that has been incredible to watch is General Electric. The company has been reborn into different businesses, and today the market is focusing on the aerospace component of GE. Stock soaring after a bullish outlook. For a little bit more on how GE is finding a way to reinvent itself, let's bring in Ken Herbert, an analyst at RBC Capital Markets. Ken, great to have you with us. For those who aren't familiar with how GE put the pieces, I suppose, back together or broke them up, what exactly has General Electric done?
Yeah, hi, great. Thanks to be with you this morning. So, if you go back several years, they've basically split the businesses up into three pieces. The healthcare business was spun off back in 2022. You spun off the energy business from the aerospace business earlier this year. So you're basically left with a business today, GE Aerospace, that's predominantly what we associate with GE, predominantly aircraft engines. They do some avionics, they do some other pieces, again, predominantly for commercial markets, but then they do some government work as well. But it is a pure play aerospace and defense company today, and clearly benefiting from all of the secular tailwinds we continue to see in that marketplace.
Yeah, and that's the one that has the GE symbol. So if you're buying GE, you're making an investment based on the aerospace industry. Just to clarify, what is it about the aerospace business that is going right for GE right now?
So I would say two things in particular. One, travel, as you probably noticed, continues to be very robust on a global basis. GE is the largest supplier of engines into the global airline industry, and while we've had some execution challenges from some of the airframe OEMs in delivering aircraft, there is a very strong demand out there and very healthy backlogs. But I would say more importantly for GE, they're very exposed to the services market. So this is a part of the industry that GE has always done incredibly well in. But when you think about then all of these engines flying, you think about the use of all these engines, there's a phenomenal demand for spare parts to support these engines and for maintenance work to keep these engines flying. So their services business, for example, in 2025 should grow low double digits to mid-teens. They raised their guidance today with their print on the services business, and that's really propelled by the spare parts sales and increasing visits of engines into maintenance shops.
Okay, now when it comes to how Wall Street looks at this business, there's definitely a lot of support for how GE is executing, and I don't want to put words in your mouth, but I think you would fall into that camp. When I look at what happens to the stock, which has had this big run-up, I would say equally that there seem to be a lot of people that think that the current value of the stock would represent fair value for the business. So how do you determine what's happening with the business and compare that to what's been happening with the stock?
So to your point, GE came through a fairly significant spin process, and that unlocked a lot of value, and the stock really benefited in 2023 and through 2024 on the back of those corporate actions, if you want to call it that. But the spin process to get to a pure play aerospace and defense stock. The aftermarket or the services side within aerospace has been incredibly strong back into 2021, 2022, as we started to fly again, and as we started to gradually come out of the pandemic. You first saw a significant recovery in domestic travel, which was followed about 18 months later by international travel. But so you had some phenomenal growth rates in services markets, 40-50% in 22 and into 23. So we are seeing some normalization of that growth. I would say that we are still, a low double digits to mid-teens growth for GE services business is still 400 to 500 basis points over what I would call a normal number. But for a lot of stocks, GE Aerospace in particular, you combine the strong run of the valuation with what a lot of investors would view as, sort of slowing growth on a more peak multiple, slowing growth on the services side. And that's led to some, the stocks moved sideways for much of the second half of 2024 after completing the spin process. So there was a lot of anticipation into the final spin process with the energy business. Then, of course, you had a pure play aerospace stock. There clearly was some concern about sustainability of the elevated growth on the services side and how that would impact the business over the next few years. But what we've seen with the results today is I think that thesis is still very much intact and continues to be one of the key reasons we think GE Aerospace will continue to be within the broader aerospace and defense complex, a very, very highly sought after stock.
And then one final question for you. Boeing is a big customer. How big a customer, and how much of the future depends on orders and success for Boeing itself?
So it certainly is dependent upon sort of execution increasing and improving across the supply chain. Obviously, the majority of its sales are into the services market. So its sales up, for new aircraft production is less than half of the revenues. And the irony is, if we do continue to see struggles in terms of delivering of new airplanes, and the demand holds up from a travel standpoint, that's incrementally positive for GE. We think GE works either way. They are obviously delivering a lot of new engines, and as those engine volumes increase, that's good for margins and the drop through. And we think incremental margins there can be powerful. But as long as the flying demand remains healthy, if there is continued struggles to deliver new airplanes, Boeing will benefit because the airlines will continue to spend on the existing and legacy assets and engines, which ultimately is where GE makes a disproportionate amount of its profit.